Hello and welcome to Trust Issues with me, David, from Kepler Trust Intelligence. Today we're going to be exploring the investment opportunity within emerging markets with Loong Lim, who is a Senior Investment Director at WhiteOak Capital. WhiteOak is the investment advisor to the Ashoka WhiteOak Emerging Markets Investment Trust, or AWEM. AWEM was launched in May 2023, meaning it has a short but impressive record of outperformance, with a net asset value total return of 23.4%, which is above both its average peer and its benchmark index. Long, thanks for taking the time to talk to us today.
Thanks for having me, David.
You've just got back from a trip to China, which seems like a good place to start today. Obviously, China's been having a few structural issues in terms of its property sector, which has meant that the post-COVID hangover of low consumer confidence has stuck around for a long time. We've obviously seen some attempts at stimulating the consumer economy in recent months. I wonder what insights you might be able to share with us from your trip.
Yeah, certainly. So, when you think about the headlines in the Western media around China, it's always very doom and gloom at the moment. But it's worth remembering that China was actually one of the best, if not the best, performing emerging markets in 2024 within EM. So things can change very, very quickly. So that's why at White Oak we actually like to run a balanced portfolio. We don't think it's possible to time rotations in and out of markets all the time. So, as bottom-up stock pickers, we don't tend to have views on individual countries. But as you said, I've just back from China, and I was actually there in 2024 around the same time. So let me kind of give you my thoughts on that. So things are fairly muted, and you asked about real estate. So if we focus on that for a minute, actually throughout last year, we were hearing these crazy stories such as property developers running out of cash to pay suppliers. So if you were a pipe manufacturer selling to a property developer, you were getting paid in unsold apartment blocks rather than actually getting paid cash. Now, one thing that hasn't happened, which you might have expected to happen already, is the government rolling in with a large stimulus. This has happened many times in the past, and realistically, all it's done is kick the can down the road, and the real estate market has continued to struggle. I think it's actually a positive thing that the government hasn't done it this time and they're willing to take a bit more pain because the industry does need a cleanup. So, more broadly, if we think about the wider economy, again, the market's been a little bit disappointed with the stimulus that has come so far, and it's kind of largely anticipating or hoping for new stimulus. But one of the good results I think has occurred is, previously in previous years when there were little down cycles or little challenges in the economy here and there, when I spoke to Chinese management teams, the response would typically be, oh, the government's going to launch a bailout, the government's going to focus growth in this sector, so we're just going to pivot the company and we're going to grow our way out of trouble with help from the government. This time, when you speak to management teams, actually what you're hearing is, oh, the government doesn't have the ability to bail us out. So actually what we're going to do is we're going to change our strategy. We're going to work on these things. We're going to focus on growing new markets, new products, cutting costs. So I think in the longer run, whilst there might be pain in the short term, I actually think you're going to have better companies that come out of this and definitely more mature management teams. I think also the point to note here is broadly the environment is still tough, but actually on this trip relative to last year, there were some signs of cautious optimism, especially in more cyclical sectors such as automation. You're starting to see some green shoots with companies starting to see orders pick off, admittedly, what is a very low base. I don't think anybody's predicting a strong recovery in the near future, but it definitely feels like things have stabilized and could start to turn a little bit more positive.
Thanks. And China also plays a part in this next question. It's worth pointing out here that AWEM has a structural overweight to more democratic countries, alongside an underweight in state-owned enterprises. Why is this, and how does it benefit the trust?
Yeah, sure. So if we talk about the way we think about country positioning first, so to be clear, we're bottom-up stock pickers. So even when we're overweight or underweight a particular country, we're not expressing a view on whether that market will out or underperform. As bottom-up stock pickers, when we are overweight, it's coming from a bottom-up basis. It just means that we're finding more good ideas in one market relative to another. So countries that are more democratic in nature, they tend to have better rule of law, better property and better intellectual rights, and better governance when it flows through to that. Now, we like great businesses at attractive valuations, so it's easy to see why we would think that we will find more of these in more democratic countries. If you look on the flip side of it, in more autocratic regimes, you tend to get a level of unpredictability. You can think of it as adding a random variable into the mix. Now, think back a couple of years in China when the authorities clamped down on the Chinese internet companies. You could have been the best internet analyst in China from a bottom up basis. But regardless of which company you picked in the sector, when Xi Jinping clamped down on these companies, all the stocks would have done badly regardless of what the bottom up fundamentals were saying. So that's that random variable that we talked about that autocratic regimes tend to have. When we talk about state-owned enterprises or SOEs, this is really simple. In emerging markets, and actually even in developed markets, be it China, Brazil, or anywhere else, these companies are usually run as an extension of government policy. They're very rarely run for the benefit of minority shareholders. There are some exceptions, but generally these companies tend to be poorly run from the perspective of minority shareholders such as ourselves.
Sure. And another kind of bias that AWEM has is towards small and mid-cap companies with a weighting of about 40% currently to mid-caps versus about 17% in your benchmark. So, very much overweight there. What advantages does that give you in terms of adding alpha?
Yeah, at WhiteOak, we strongly believe that in order to generate strong alpha on a sustainable basis, you have to be active in the small mid-cap space because of the stronger alpha opportunity that's present there relative to large caps. Now, it's been shown in many studies that the small mid-cap segment of the market is less efficient than the large cap segment. A less efficient market in theory means higher potential for alpha generation. So the way we think about it is from a bottom-up perspective, the small mid-cap segment of the market is alpha rich, meaning we are more likely to find great businesses with attractive valuations here relative to the large cap space. However, it's been proven many times that just blindly being overweight small mid caps will not result in superior alpha generation on a long-term basis. This is because small mid caps come with more risk. There's less information about these companies available, there's less research out there, governance standards can be lower, and liquidity tends to be much, much less as well. So, in order to successfully extract alpha from the small mid cap space, you actually need to dedicate a significant amount of time and resource to this. So at WhiteOak, we have a very large investment team, 45 people, just looking at emerging markets. We also work within what we call a team within team structure, and often several analysts are working together on a single name. So this will allow us to really dive deep and do the homework on these companies that are under researched. So we really understand both the business model, but also the risks that come with investing in this part of the market.
And that does bring me on to another question about the number of holdings within the portfolio, which at last count, I think the last fact sheet stood at 184 at the end of November. Why is it that you run a portfolio with so many individual holdings?
Yeah, it's a good question because, we've all read the literature that suggests portfolios should be very highly concentrated with big bets on high conviction ideas. At WhiteOak, we do not buy into that philosophy, but we can hardly claim to be pioneers because after all, one of the greats of investing, Peter Lynch, he ran the Magellan Fund with over 1,000 names in the portfolio at certain points. So the, the idea is that rather than have all our alpha come from a few large sized bets and all the risk that that kind of concentration entails, our alpha is typically generated from many small bets. So despite the number of names in the portfolio, it's worth noting that our active share is typically around 70%. So we are not a benchmark hugging fund. So why so many names? So as we touched on, in order to generate strong alpha, we think you need to have an overweight to that small mid cap space. But that liquidity constraint that we talked a little bit about, in order to manage risk, we typically only invest a very small part of the fund in each individual small cap name, maybe 20 or 30 basis points. So in order to have a significant part of the portfolio in that small mid cap space, you need a much larger number of names. So previously mentioned, again, this is not something you can do unless you have a large team like we do. What we like to say is, whilst we run a very diversified fund at the portfolio level, we are concentrated at the analyst level, meaning the number of names that each individual analyst has to focus on isn't large, allowing them to really understand each company that they're responsible for.
And as ever with the emerging complex, there's plenty of uncertainties. I mean, we're recording this today on the 20th of January, which is obviously Donald Trump's inauguration day. We've got uncertainty such as, any kind of tariffs that kind of emanate, put on countries like China, Mexico, and whoever else kind of happens to be in the crosshairs. But I wonder, obviously worth talking about, the attractions of having a little bit of exposure to emerging markets in an investor's portfolio. And, are there any kind of countries or individual names that you're kind of particularly bullish on moving forward, and you're seeing an outsized ability to extract alpha?
So, yeah, I think regardless of which markets you invest in these days, certainly geopolitics and geopolitical tensions and uncertainty are a fact of life. In emerging markets, what's been dominating the news headlines is the potential imposition of a new tariff regime. I've just got back from trips to South Korea and to China, and interestingly, the companies here are not panicking. So they've all seen this before in the previous Trump administration. And I think back then they were shocked that it wasn't just rhetoric and, actual tariffs were imposed. So I think now they're more prepared for it. I think they've done what they can to diversify production capacity into different geographies, or in the event that a tariff is imposed globally, regardless of where you produce, a lot of them have actually started exploring new markets like the Middle East, for example, or Eastern Europe. So I think, if there is really a 60% tariff imposed globally, like they kind of have been threatening to do, I think undoubtedly that will cause significant disruption. But I think companies have a way of working their ways through this. And if you look at the last round of tariffs, certainly it wasn't as disruptive as the reports in the media said they might be. Now, in terms of where we see opportunities, I think actually you're still seeing opportunities in many areas within emerging markets from a bottom-up perspective. The uncertainties that we've talked about here, they're actually throwing up a lot of good valuation opportunities. So many high-quality businesses are trading at significant discounts to historical levels. So we talk about one niche where the team has been finding a lot of ideas. It's in countries that are large enough or economies that are large enough where you can find domestic champions, where they can be domestic leaders that don't actually have to export, so they don't need to have revenues to the US or to any other countries. And these companies are usually domestic champions that the government is supportive of. So what you actually find here is not only are they benefiting from being a leader within a growing part of the economy, a lot of the time they're actually aided by what we call import substitution, where these locally made products are now of a high enough quality that they can replace a lot of expensive foreign products. So I think to sum up this part, we're saying yes, we know that there will be disruption, but I think that's always going to be the case, but we are still finding opportunities as well.
And now one kind of slightly differentiated aspect of AWM, which kind of loops back to the small cap point, is that it has the ability to invest pre-IPO. And in many cases, it receives anchor allocations, which means it's the main investor in that IPO. Now, I wanted to just pick up on India because obviously it's a country that WhiteOak itself, has a focus on. Now, there are a record number of IPOs in India in 2024. Has this generated significant outperformance? And could you just kind of, walk us through that kind of part of the portfolio?
Yeah, so this is a really interesting, I guess, quirk that's unique to India and also unique to us, given the presence that we have in India. So India in 2024 was the second largest equity fundraiser, only behind the US in terms of value. But in terms of names on primary and secondary listings, I think India actually eclipsed the US. So what this does is it helps to increase the number of companies in that small mid-cap space that we previously discussed. So the opportunity set for us in India just continues to get larger. Now, in terms of the pre-IPO and the anchor allocations, so we have a couple of names that have done very, very well for us. So, for example, KRN Heat Exchanger, as the name suggests, they're a leading manufacturer of heat exchangers in India. That's contributed significantly to the NAV. That was something that we took part in as part of a pre-IPO. Similarly, DOMS Industries, a very well managed stationery and business in India, that's also performed very well for us. A quirk that the India market has, it's a lot of private companies, before they take part in an IPO, they like to have a reputable public investor already on their shareholder register. They think that this helps them develop trust in the public markets and therefore get better valuations. So if you are chosen to be this kind of pre-IPO public investor, you tend to get good allocations at very good prices. So WhiteOak and AWEM, we can invest 10% of the trust in pre-IPOs, which is not something that all our peers can do. And additionally, the reputation and size of WhiteOak as a firm within India gets us a lot of access to these opportunities. So I think we're very well positioned to benefit from the opportunities here.
Now, I hope that listeners found that discussion as interesting as I did and can take plenty away about the outlook for emerging markets as well as the investment case for AWEM. Loong, thanks for joining me on today's podcast.
Thanks for having me, David. It was fun.
Now, remember to check out the KTI website for our initiation research notes on AWEM, as well as a feature article and video introducing the trust. We'll also link to AWEM's website in the video description for further information. Thanks for listening today, and we hope to see you soon.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.